Washington Journal continues.
Roben Farzad, who is a special correspondent for the PBS NewsHour, also the host of an NPR podcast, Full Disclosure. You can check him out on Twitter. Good Sunday morning. Thanks very much for being with us.
Likewise. Happy New Year.
The Dow above 20,000. What does that mean?
Very little, actually. The Dow is the way it's calculated even is a throwback to the early 20th century. It is broadly the stock market writ large, a weighing machine, as one of the founders of Vanguard once said, of economic activity and the animal spirits of buying and selling and whatnot. And I think it's yet another telegraphing to consumers and the rest of the world that corporate America has kind of regained its groove after what we saw in 2008 and 2009. But it's by no means, the ultimate metric that people should be following. And
what we saw in 2008, 2009, the collapse of the economy, many saying that it was on the brink of a Great Depression, and one of the direct results of that, the Dodd-Frank legislation, the president on Friday signing an executive order in the Oval Office rescinding some of those regulations. Good or bad?
The verdict is out. You have an institutional memory of these things. By the time 2008 rolled around, very few people remembered the abuses of the late 80s and the savings and loan crisis. Very few people were left on Wall Street that could say, I lived that, and the crash of 87 and the systemic abuses we saw. And so, by the time the 90s rolled around, effectively people were free to lend again, to forget about the importance of Glass-Steagall, which separated investment banking from retail and commercial banking, and we got complacent. And the concern is that kind of 9 years after the fact of 2008 and many of the abuses that occurred in 2006, 2005, we've effectively forgot kind of what took us to the brink. These crises never follow the same template over and over again, but they happen in these cycles, and there's a universality toward kind of we see in history time and time and time again under-regulation and overshoot with over-regulation. Very rarely do you have the perfect equilibrium that keeps Wall Street and Main Street and corporate America happy.
I want to come back to that point, but also let's talk about jobs in the economy, because in January, the Labor Department saying 227,000 new jobs added. And the headline from the Chicago Tribune, this jobs report of the Trump era, the first for Donald Trump, showing that he inherited a strong job market.
Yes, has very little to do with Donald Trump at this point, even though he'd like to take credit. If you go back to the campaign, he's actually openly disdainful of Bureau of Labor statistics, the headline number. Right now you have an unemployment rate under 5%. He doesn't believe it. He was out there continuously saying it's closer to 20%. If you count the people who've dropped out, who've stopped looking after several years, who are kind of structurally unemployed, don't buy that number. But I'm sure he's much more willing, especially as we get into the first 100 days and the first couple of years of his presidency, to take credit for reports as such that when you add something like 225,000 jobs in a kind of a print, that's something that you as a White House want to run victory laps around.
The White House also taking aim at NAFTA. What impact would that have on jobs, trade, businesses, and the economy?
What it's had right now is a sort of chilling effect in boardrooms where you realize you have the leader of the free world with an active personal Twitter handle. And he might be watching something or reading something on a Sunday or Monday, and you don't know if he's going to wake up Monday morning and suddenly take aim at XYZ lawnmower maker out of Indiana. I'm going to make it impossible for you to move your jobs to Mexico. If you'd already planned going back 5 years to offshore a certain number of jobs, you suddenly have a kind of an X factor in the White House as someone who has really an unprecedented bully pulpit and moral suasion and ability to kind of get down in the weeds and call out a company, call out the likes of a carrier. Broadly, it really brings into question, especially if you're Mexico, an enormous trading partner of the United States, has a trade surplus against us. Is this something that you accede to? Do you necessarily willingly open up and renegotiate NAFTA, which has now been on the books for almost a quarter century? Do Mexican producers, do agricultural players then effectively charge a pass-through tax on Americans? I mean, we've been hearing these stories of potentially $3, $4 avocados. I don't know if it's true, but is there going to be rioting in the streets if your Chipotle order costs $17? We don't know yet.
Especially on Super Bowl Sunday when you talk about avocados and guacamole. 202 area code 748-8000, our line for Democrats, and 202-748-8001 for Republicans. Roben Farzad is joining us from NPR and PBS as we talk about jobs, the economy, international markets, and the Trump administration. So let me go back to these regulations put in place as a result of what happened in September of 2008. And that pendulum that you said earlier swung from the 80s to the 90s, 90s to the end of the 2008, 2009. And where are we heading now, 2017 and beyond?
The perception is that you're coming off of a period of overregulation, and the White House has only had so much.
Let me stop you there. Overregulation where?
Both on banks, the capital requirements. I mean, if you look at kind of what got us to this crisis, there was this combination of, what a great investor called promiscuous lending. Just go out there and make the loans. Worry about the after effects. Risk is overrated. You could always pass risk down the food chain, sell it to other investors. There was a broad mass diffusion of responsibility. And if you're one of the CEOs of these companies or the heads of these banks, none of whom have gone to jail or very few have been successfully prosecuted, you'd be like, listen, people wanted these loans. Everybody, you wanted a HELOC. You wanted an Alt-A mortgage. You wanted a liar loan. You lied on your mortgage application. It was your responsibility. It's not our fault if you saw a once-in-a-generation plunge in real estate prices and an inability for Wall Street to effectively securitize these products. There are others, led by Elizabeth Warren, who's now the very outspoken senator from Massachusetts, the U.S. senator, said, no, this was at best kind of a cynical move by Wall Street and financial institutions, realizing that you could take private risks and then have the public pay for it. In the end, that you knew that you would not be on the hook for it. And in the end, they were bailed out, these banks, and their creditors were rescued oftentimes at 100 cents on the dollar. And the Federal Reserve, moreover, has kept rates near zero for the better part of a decade. So that debate is still very pungent, both here in the Beltway and on Wall Street.
How can people listen to your podcast, Full Disclosure?
Sure. You can go to fulldradio.com. That's the iTunes link. It's available on NPR One, Stitcher, SoundCloud, Acast, wherever you get your podcasts.
And be sure to check out the C-SPAN Radio podcast as well, released every Friday. Chase from Cincinnati, Ohio, Independent Line. Good morning.
Good morning. My question was, with all of Donald Trump's strong-arming on kind of like international trade and, these kind of aggressive tactics that he's using as negotiation standpoints, is America's financial economy and a system really strong enough to take on that in case another country, say China, would decide that they wanted to maybe fill in the spot where America decided that they wanted to negotiate stronger regulations or stronger trade deals in favor of Cincinnati?
Chase, thank
America.
you. Sure. Thank you for the call. We'll get a response. Roben Farzad.
It's a very different economy right now versus the neat precedents that we've had historically, whether you look at the Hawley-Smoot tariff and preceding the Great Depression and everything else, and the waves of protectionism and free trade that have followed in the several decades leading up to that. The big player here in real time is China. And its ascension to the World Trade Organization, I believe, which was in 2001. And if you look at the sheer growth of that economy, the masses brought out of poverty and brought into becoming a consuming class, and the huge numbers of cities that have millions of people. Never in real time have we had a true experiment of what a true, for example, trade war or retaliatory economic measure from China would seem like in this era. It's one thing if it happened in the 70s or 80s. China was far smaller back then. Now, even a player like Korea, South Korea, it's hard to argue that you're an emerging market. You're not exactly a banana republic anymore when your goods like Samsung TVs, Samsung smartphones, Hyundai cars are indispensable to the global economy. To say nothing of France, Britain. I think a lot of people think, this fallacy is that we don't have trade with the likes of the UK and Germany and Mexico, and these are indispensable partners. And if they were to band together and do something, we don't know how this would ripple systemically. We don't know how it would hurt their banks, how it would hurt the dollar. Is the system capable right now to take these shocks? We don't know.
You're getting a lot of tweets. Let me take two very quickly from Dee Fredericks. Are banks still too big to fail?
Very much so. I know you're supposed to keep full impartiality on C-SPAN and have the three lines open. There's no evidence that that really we've in the wake of what we saw with Bear Stearns and Merrill Lynch and Lehman Brothers being the big kahuna, that these enormous conglomerates have been right-sized. And if one were to fail right now, like a Goldman Sachs, that could potentially take down the entire economy. Let's look at just the JP Morgan Chase. Back in the day, JP Morgan was JP Morgan, Chase was Chase, but now JP Morgan Chase is JP Morgan Chase, Bear Stearns, Washington Mutual, Providian. If you were to open up the accordion of everything that's in JP Morgan, which by the way, Donald Trump keeps quoting its CEO, Jamie Dimon, and these measures, you could ask Jamie, I'm taking down these measures or trying to declaw the Dodd-Frank Act. Jamie will tell you it's very hard to lend. These institutions are bigger than they've ever been. You look at a Wells Fargo, it's a Wells Fargo Wachovia First Union. You look at a Bank of America Merrill Lynch, and then various places. You can go on the Wall Street Journal or Bloomberg and see how many different subsidiaries are under these things. These mega regional banks are now effectively multinationals.
Another tweet from a viewer saying, if the economy is so great, why are interest rates so low? Adding, maybe because cheap money is driving a fake market.
Very valid criticism. We've never seen this kind of period in history in the post-Depression period where interest rates have been so close to nothing. I mean, the Fed took them to near zero at the end of 2008 and has hesitatingly brought them up. They're nowhere near normalized rate right now. As I've said before, you pass by your bank branch, they put up a sign, go get them like a 3-year CD at 0.5%, as if they're doing you a favor. But this is problematic too for the banks. The banks crave a much more normalized bond curve where they can, borrow cheaper on the short term and lend out higher on the long term and pocket the difference. And we've seen nothing approaching normalcy. We don't know what normalcy is since maybe 2005, 2006. And that's the big question for Janet Yellen, the Fed chair, who after all is not a Donald Trump appointee. Can she independently take rates up in an economy that unemployment tells you we are near full employment, inflation is non-existent? Is there room without, say, taking down the Dow Jones Industrial Average several thousand points, without causing massacre in the bond market, which has been a huge 35-year bull market? Those questions remain.
Roben Farzad, who began his career at Goldman Sachs. He's also written for the New York Times, the Boston Globe, the Wall Street Journal, and Bloomberg Business Week. A graduate of Princeton University and Harvard Business School. He now hosts a podcast on NPR and is a special correspondent on the PBS NewsHour. George, Elkridge, Maryland, Democrats line, good morning.
Well, good morning. How you doing?
We're fine. Go ahead with your question. Good morning, George.
Okay, here's one of the things I like to ask. We had the Glass-Steagall Act in place for many, many years until Clinton abolished it, and then we went into the crisis, and after the crisis, we went to Dodd-Frank. Now, Trump is trying to, I guess, rewrite the Dodd-Frank Act. But here's what I really want to get at is if your person there with you can talk a little bit about the petrodollar and how explain it to the folks and how that's going to affect the United States if the Middle East somehow or another is able to destroy the petrodollar.
George, we'll get a response. You're looking puzzled. Well, kind of the Middle East influence in this case ebbs and flows. There are a couple parts of that. If you look back to, let's go back to 2008, not to harp on it. Oil prices broke $140 a barrel. People were routinely paying $4.25 a gallon in the United States. And that's actually one of the other exogenous factors that helped crash this economy. That was unsustainable. Companies found they couldn't pass through the price increases, the fuel costs. That was the prime time if you wanted anything resembling kind of a, the OPEC shock of the early 70s for the Gulf nations to put a squeeze on the United States and to see some sort of crisis with the dollar because, after all, oil at OPEC is dollar denominated. But what happened instead was this kind of fracking revolution and, say, North Dakota becoming effectively the smallest member of OPEC, a huge explosion, actually, in finding that the United States sits on an ocean of BTUs, effectively, whether oil, shale oil, or natural gas, or other liquids. And that has kind of really thrown a wrench into OPEC's calculations. I mean, much less than before do we wait with bated breath for OPEC to come out with a decision to cut. There's never been this lack of unanimity, this enmity actually between the likes of Saudi Arabia and Iran, and Iraq has different priorities, and suddenly if those guys decide to cut production, the players in the United States shale patch and the oil patch and the Permian Basin and everything here decide, okay, great, let's just flood the plain with our oil and capture market share. So very few people are paying attention to that. I think the bigger question, and not to get into the weeds, is if China has a hard landing, if China for the first time in 20, 25 years really sees an economic decline, will that crash oil prices in a way that causes some sort of crisis in OPEC? And moreover, will that snuff out the incipient players in the United States? I think that is the bigger question. OPEC has certainly lost a lot of clout over the past decade.
To our radio audience on Sirius XM and C-SPAN Radio, our topics: the economy, jobs, trade, and the markets with Roben Farzad. Al is joining us from Charlestown, Rhode Island. Good morning, Republican line.
Good morning. Thanks for C-SPAN. Mr. Farzad, you've got a few things wrong. Number one, the thing on Wall Street is they've been gobbling up all the small banks. You need to change Dodd-Frank because the small banks can't lend. The damage was done by the big banks.
Al, stay on the line. We'll take that first point and come back and follow up because that's an important issue.
They have been complaining about that they can't lend. But why can't they lend? Is it that they don't find opportunities there? Is it really because of the quote-unquote onerous regulations that Dodd-Frank put on them in terms of the paperwork and the boilerplate, and actually approving a loan and a mortgage is a huge problem right now? I buy that. I just think that some of the problems are much more mundane. The demand hasn't been there. You have small business owners who complain about the access to credit, but you also have a real estate market here in the United States that has changed enormously. It's far less speculative using cheap mortgages, and it's far more kind of people making cash acquisitions or investors, commercial property flippers in it that are really not the kinds to interface with a small community bank. And the complaints that you see, I think, at the mega regionals and the mega banks, like a Citi, like a Bank of America, like a Wells Fargo, is that we're just being bogged down in the red tape and the boilerplate and all the different checks that we need to extend a person a loan. I'm not sold that is the real bottleneck in terms of getting credit out there. I think it's much more about underlying economic activity, and there's still a lot of people who have cold feet about taking on debt.
Let's follow up with Al, who's on the line still from Rhode Island. You want to follow up?
Yes, I do. You're still wrong, because the basic start of a business comes from a small bank. Now, I'm telling you about banks around here. It's too stringent. They can't put money out. They're afraid to lend money because the amount of paperwork they have to put out for a $20,000 loan is the same as what Wall Street puts out for their $20 million loans. And that has stymied business, stymied growth, and stymied our economy. Where as far as hiring people, that's really the key. Dodd-Frank has taken and put because if you look at the banks that the big banks have gobbled up, they gobbled them up because all these small banks, the board says, let's just sell it, let's build our market up, let's sell our banks to the big banks. And that's what Wall Street has done. It's greed. And it starts on Wall Street. You come from Goldman Sachs, one of the biggest offenders there is. There's not a bigger offender on Wall Street than Goldman Sachs. And what happens is they have taken the power of the individual person in these small towns, big towns, cities, be it wherever, where it makes it so much harder for them to become an entrepreneur, to be able to grow their business, hire 2 or 3 more people. Now let's put on top of that what Obama did with the health care, where people, they're afraid to pay. They have to pay taxes. The employers have to pay taxes or keep the hours down to 32 hours. And I'll tell you the other thing with China. The best thing we could do, we have China now in a weak spot. If China's growing their military, but what we could do is take all our American companies out of China where they're not manufacturing, and that country will fall from within like Russia did. But the banking, you're too close to it. Coming from Goldman Sachs, all you're thinking about is the large banks. It's the small banks, son. The small banks made the big banks big.
Al, I'm going to just stop you there because you put a lot of issues on the table. We'll give our guest a chance to respond. Thank you for the call. If
you're trying to think back to this era of Jimmy Stewart and It's a Wonderful Life and Even when I came to the United States in the late 70s and early 80s, I remember going to American Savings and Loan in Miami with my dad, and you'd meet the banker and they'd take my pennies and they'd count my pennies and they'd give me a toaster and they'd give my mom a blender. Consolidation is consolidation. And whether you want to vilify Goldman Sachs or JP Morgan Chase, anyone out there, these banks have long since realized that they can't compete in an environment with mega regionals, which were Wachovia. Wachovia almost failed. Wells Fargo, which was really a West Coast thing, which came aggressively into the East Coast and Florida and Virginia. Bank of America and Merrill Lynch. I mean, for a long time, Bank of America and Nations Bank, these things happened well before the financial crisis. There's just a wave of consolidation that's happening. And I think there is truth to this idea that, you walk into a bank right now, you walk into a Bank of America, you're lucky if you get a teller. They want to push you online. They want to push you to do direct deposit. It's not a whites of the eye transaction anymore. It's more automated. They want to cross-sell. I mean, that's one of the big problems that Bank of America encountered with its Merrill Lynch acquisition. And that is frustrating. I would like to have there's still near me a 60-year-old bakery that I like to frequent to buy pastries for my kids or take them in there, and it's like a time warp. I just don't get the impression that there are many banks that can do business like that anymore. There have been these irresistible urges for them to sell out and merge.
Our guest is coming out with a new book this fall called Hotel Scarface, where cocaine cowboys partied and plotted to control Miami. When's it going to be released?
It's coming out in November. We're going to debut it at the Miami Book Fair.
And we'll be covering that book fair, so we'll be looking for that as well.
Thank you.
Be sure to check out all of our nonfiction book coverage every weekend on C-SPAN 2's Book TV, and today, In Depth. You can get more details on our website at cspan.org. David, Panama City, Florida, good morning.
Good morning. I'd like to say something to Mr. Farzad. I really resent that cavalier attitude that people like Mr. Farzad and liberals have on jobs going overseas, especially his comment about the lawnmower job that he's talking about. Now, this lawnmower job is very important to the individual American. It pays his mortgage and his family. Americans are really getting tired of having to send their paychecks to Mexico and other countries, and this has to be realized by the upper classes of America. And this is why we elected President Trump. That's all I have to say.
David, thank you.
I did not in any way mean to seem cavalier with that. The lawnmower example is, I just remember going and doing a story for Business Week 5 years ago at Subaru of Indiana, which is an auto plant near Lafayette, which is really a model auto plant of making Subaru Outbacks and Subaru legacy cars, a handful of Toyotas, and just everything that this company had to do to keep those jobs onshore when it is almost irresistible for them to move manufacturing to Mexico, where the per hour labor costs are just far smaller, where you could really be much more competitive. And I took the example of a lawnmower company, not to denigrate lawnmower companies or lawnmower users, but it's the same problem. If you have a Chinese upstart or even a Mexican company that can get its act together and offshore, the labor input costs versus, say, manufacturing that in Indiana are just far smaller, and you can undercut the final price. Now, a Harley Davidson, for example, with motorcycles stands out because it has such brand affinity, and it's so, it's made in America, and you want it made in America, and you cannot imagine it being offshored from China. But we've seen unprecedented gains in IP and in replication and the ability to kind of ape products from not just China. You've seen it from Korea. You've seen it from Malaysia. A lot of flat screen TVs that you could only imagine being made in Japan as recently as 25 years ago are made in these brand new megalopolises in China. And it's happening in Malaysia. It's happening in Indonesia. And I in no way intended to be cavalier. I'm just saying it's dog eat dog out there in terms of competing on products.
Let's hear from Fatima in Fort Washington, Maryland, outside of Washington, D.C. Good morning, Democrats Line.
Hi. My question is this. I understand just recently Russia and China signed a deal to bypass the dollar and pay each other. Actually, they're trying to undercut the domination of the U.S. dollar as an international reserve currency. How would that affect our economy?
Remains to be seen. China has for a while kind of implicitly and explicitly said that the yuan could be the next reserve currency of the world. When China is strong, I mean, it can say that. It can say that, look, we are the second biggest economy in the world, and within decades we'll be the biggest. Maybe not on a purchasing power parity kind of apples to apples basis, but the trend is the trend. If that cuts out the United States, it could hurt the dollar, which would make it more expensive for us to buy things overseas and imports. But China has really no vested interest in hurting the dollar. China needs a strong dollar. It wants Americans buying Chinese wares. It keeps a strange peg from its yuan to the dollar. It doesn't let the currency float freely.
Is it manipulating its currency?
I believe it is. It does. It's not a free player. If it was out there, loosely doing this, you'd see much more appreciation in the yuan. You'd see it be much more difficult. But China has an enormous reserve of dollars. China was a voracious buyer of U.S. treasuries, and China can flood the market or deprive the market at any point in time. But as a previous caller mentioned, that would really be cutting off your nose to save your face. China lives and dies by manufacturing, and it says every now and then that we want to be much more of a domestic consumer consumption-based economy, but there's no evidence that is anywhere close to what it would need to kind of wean itself from American exports.
And let me conclude with this tweet, again going back to Dodd-Frank. This is from John in North Carolina, who frequently sends us a tweet, so thank you for that, saying that part of the problem with Dodd-Frank, it made me stop closing home loans after 35 years. The red tape made it unprofitable. The attorney fees doubled. And we've been hearing that a lot.
Yeah, and I think this does go back to the pendulum of overregulation and underregulation. This is a period, Donald Trump's election is indicative of, I think, a perception of overregulation, or a perception that maybe Washington got too big, that the overreach was there. And he's come in on an anti-DC, and he's wasted no time in that first month with executive orders. And, taking down Dodd-Frank, this executive order is effectively, it's a shot across the bow saying that this is what we're doing. We take it seriously. I promised this during the campaign, and I'm instructing my Treasury Department, which still doesn't even have a confirmed Treasury Secretary, to give me the rapid and expeditious instructions, even though Wall Street knows that a lot of these things might well not be implemented until 2019. The fact that this is telegraphed across Wall Street, the fact that bank stocks have been doing rip-roaringly well since Donald Trump's election, the fact that he's out there surrounded by Wall Street people, even though he ran against Wall Street. It's kind of like, follow what he does more than what he says.
Roben Farzad of PBS and NPR, your podcast, Full Disclosure. Thank you very much for being with us.
Always a joy, Steve. Thank you.
Who's going to win the Super Bowl?
God, please let it be the Falcons, not Tom Brady, not the Pats.
Okay, well, we're not going to talk about the Falcons or Tom Brady and the Patriots specifically, but